Hey everyone, and welcome to this explainer. Look, we all know money went digital a while ago, but what we're actually living through right now, it is a complete structural teardown of the entire global economy. Today, we're going to decode exactly how this revolution is happening, breaking down the massive shift in how we borrow, save, invest, and protect our hard-earned assets.
Okay, let's dive right into this. Here is our roadmap for today. We're going to cover welcome to the digital economy, the core tech of FinTech, real-world FinTech applications, the promise and the peril, and finally, securing the financial ecosystem. All right, let's jump in.
Section 1. Welcome to the digital economy. Think about it. Every single time you tap your phone to buy that morning coffee, you are interacting with a massive, invisible infrastructure that completely bypasses the legacy systems we grew up with.
Now, you might be wondering, and it's a really fascinating question, why do consumers choose FinTech over trusted traditional banks? I mean, it's a massive shift. Why on earth are millions of people moving their trust away from physical institutions that have been around for a century over to an app on their smartphone?
To figure that out, we got to look at what FinTech actually is. Simply put, it's the innovative use of technology in the design and delivery of financial services across both B2B and B2C segments. It basically takes this sprawling, complicated world of finance and just ruthlessly cuts out the friction. It eliminates potentially unnecessary steps for everyone involved.
Now, what's really interesting here is the stark contrast. Traditional banking, it's historically had super high barriers to entry and really slow, rigid processes. But FinTech institutions are remarkably agile. They offer lower fees, incredible ease of use, and massive scalability. And because they operate with an asset-light nature, they don't need thousands of brick-and-mortar branches to serve millions of customers.
Moving on to Section 2, the core tech of FinTech. Let's pop the hood and look at the actual engines powering all this agility. We can basically break this down into the ABCDs of FinTech. These are the 4 foundational pillars completely redefining how we move, store, and protect our digital cash. So A is for artificial intelligence, providing incredible insights on consumer behavior and spending habits. B is for blockchain, which allows for totally decentralized transactions without needing a third-party middleman. C stands for cloud computing, literally the backbone making all this massive scalability possible. And D is big data, giving companies the analytics they need to predict market changes. Put them together and it's an absolute powerhouse of innovation.
Because of this, we're moving entirely away from old-school paper ledgers and diving into complex, interconnected data networks. By fully digitizing financial data and running automated analytics, companies can objectively custom-tailor products for super-specific customer segments in literal milliseconds. I mean, way faster than a human ever could.
All right, Section 3, real-world FinTech applications. Let's see how those ABCDs actually manifest out there in the real marketplace to solve problems.
These foundational technologies are actively democratizing finance through a few major products. You've got peer-to-peer, or P2P lending, which connects borrowers directly with lenders, totally bypassing the traditional bank middleman. Then there are crowdfunding platforms, letting businesses raise small chunks of debt or equity from tons of regular internet investors. Distributed ledger technology, like blockchain, allows members to verify transactions without some big central authority stepping in. And finally, robo-advisors. These are digital platforms giving you automated, algorithm-driven financial planning with little to absolutely no human supervision.
Let's move along and see how this builds into 5 transformative use cases that you probably interact with all the time. Number 1, mobile payments. Basically, apps that let you tap your phone to pay securely using tokenization. Number 2, retail banking, which is finally opening doors for folks who found traditional bank fees way too high. Number 3, blockchain and crypto, offering crazy high traceability in smart contracts. Number 4 is InsurTech, which we're going to expand on in just a second. And number 5, payment gateways. That's the invisible digital infrastructure making modern e-commerce even possible.
To ground all this jargon a bit, let's look at InsurTech as an example. This is simply combining insurance and technology to automate all those old, labor-intensive processes. A perfect real-world example of this is Policy Bazaar over in India. They act as this massive online aggregator, making health, life, and travel insurance highly accessible. Instead of spending weeks drowning in paperwork with a broker, a consumer can compare and buy a policy in literally minutes.
Next up, Section 4, the promise and the peril.
Look, a revolution of this scale definitely comes with growing pains. So let's take an objective look and impartially weigh the massive societal benefits against the very real risks.
The promise here is absolutely vast. We are looking at a massive engine for job creation. It brings rapid efficiency, turning things that used to take days into actions that take mere seconds. And thanks to those resilient distributed ledgers, our systems are actually safer from data loss. It's also forcing legacy banks to step up and compete. But honestly, the most profound promise? Financial inclusion. Mobile platforms like M-Pesa have successfully brought millions of previously unbanked individuals right into the formal financial system. It is a real game changer.
On the flip side, though, the perils are just as severe. As society rushes toward going cashless, people without digital skills face harsh digital exclusion. There are also substantial concerns regarding algorithmic discrimination, where automated decisions end up carrying biases against certain groups. Plus, the volatility and anonymity of some of this tech opens the door for incredibly sophisticated scams. There's the constant threat of your data being silently harvested without your consent. And finally, what happens when the tech just fails? We saw this systemic peril firsthand back in 2018 when the Visa network crashed, causing over 5 million payments to fail and basically grinding commerce to a halt.
Which brings us to our final act, Section 5, securing the financial ecosystem. Because of those severe perils, the industry and governments are having to build an absolute fortress to protect users. The very foundation of that fortress is called Data Protection by Design and by Default, or DPBD. What this means is that security and privacy can no longer just be an afterthought or some patch you download later. To meet strict regulations today, data protection has to be baked directly into the DNA of a product from the exact moment developers start writing the code. And a major part of that design philosophy revolves around the CIA triad: confidentiality, integrity, and availability. A digital transaction is only considered safe and successful if all three of these requirements are fully met. If there's a data leak, you've lost confidentiality. If data gets tampered with, you've lost integrity. And if the system goes down when you need it, like that Visa outage, you've lost availability. FinTech apps absolutely have to satisfy this entire triad to keep consumer trust.
But tech companies aren't just out there policing themselves. Enter the regulatory guardians. Regulators, like the Reserve Bank of India, are walking a very tricky tightrope right now. On one hand, they want to create an environment that encourages unhindered innovation to expand banking access. But on the other, they have to balance that with strict consumer protection laws, enforcing rigorous Know Your Customer and anti-money laundering, or KYC and AML, requirements just to keep the bad actors out. So the crucial point here is that these regulations actually have teeth. Take Section 72A of the IT Act 2000, for example. It explicitly states that disclosing information without consent in breach of a lawful contract is punishable by imprisonment and fines. So yeah, there are severe, real-world legal consequences waiting for companies that mishandle your sensitive data. Security is literally not optional anymore. As we wrap up this explainer, I want to leave you with a final provocative question to think about. In an increasingly cashless society, driven by algorithms, who truly controls your financial data? We've seen how FinTech brings incredible speed, inclusion, and convenience through AI, blockchain, cloud, and data. But as these digital ledgers hold more and more of our lives, it is absolutely crucial to stay informed about how our data is being used, protected, and regulated. Thanks so much for joining me to decode this digital revolution, and remember to keep asking the big questions about your own digital footprint.